Our topic today is day trading. But really, what is day trading? Because is there really such a thing, okay, in the Forex market? Because if you think about what day trading is, and yes, we're definitely talking about my 5-minute setups, but a lot of people liken it to day trading. And I want to discuss and maybe debunk a few things about it. Number one, the first kind of trading was day trading, if you consider Wall Street when it was literally a field next to a big wall, if you think about what Wall Street was. And day traders were basically the market participants. I don't think they called what they did day trading, but essentially they went home flat at the end of each day, which is what day trading is. It's not a strategy. There's no such thing as a day trading strategy. Day trading is simply describing what your position is at the end of the session, which is nothing, flat. And the reason for that back then was, who's going to do the accounting? Who's the one guy, the company, or the person you're going to trust? All these market participants are going to trust to do the accounting. That's a big leap of faith. So at the end of each day, they reconcile with one another. They reconcile buys and sells and everything else, and called it a day. If you remember, I don't know how many of you caught this. CNBC, I think, did it. It was a history of Wall Street, and it's actually a book. And they did a little 1-hour, 2-hour documentary, and it was an excellent book and video, or I should say movie or documentary by CNBC. And they talk about this in that documentary and in the book. I don't have the name of it, but I think it was called The History of Wall Street, and I'm sure the video is available at CNBC. And I thought it was excellent. It was mostly about stocks, but it was really the birth of the speculative attitude that we have in this country, and how it helped also basically help grow this country. So to me, it's a fascinating look at the markets. Now, we don't have necessarily a single day or a session when it comes to Forex, do we? We have a 24-hour trading day, but that doesn't mean we close at the 24th, at 23:59. Doesn't mean we close, right? It just keeps right on going from Sunday afternoon to Friday evening. So is there such a thing as being flat at the end of the day? We could be flat at the end of a certain session, whether that be, for example, the European or the UK or the US or the Asian session, but there's really no such thing as being flat at the end of the day. So day trading is kind of in my definition, a misnomer. Okay? So again, day trading is not a strategy. It simply describes your position at day's end. But we've just agreed, and I think we all agree, there's no such thing as a day's end in Forex. Week's end maybe, right? But not day's end. So I don't call what I do in Forex day trading. I may day trade stocks, which I do. I day trade futures. But those markets have an exchange that opens and closes each day. Even if there isn't after hours, there are real trading hours where the market actually has an open and a close. We simply don't have that in Forex. So my 5-minute strategy is more about risk. Day trading or being flat at the end of the day, what was that, by the way? It was a risk consideration, was it not? It was a way to limit what could happen when the markets were closed. When you don't have an open position in the market, in essence, you're attempting to limit risk. Risk, to a certain degree, if you think about it, correlates to your exposure to the market. When you're in the market, you're open to risk. When you're not in the market, you're not open to risk. We know that there's other types of risk, because when the market is in a volatile condition, we know our orders may not be filled as we place them. We know that in volatile market conditions, we could still have substantial losses regardless of our stop losses. We know that in fast-moving market conditions, stop loss orders can become market orders, and they might be filled at whatever the next best price, the prevailing price may be, which may differ far and away from what you intended. So can we all agree that being in the market means exposure risk? So again, this day trading isn't a strategy, but it's a psychology of being out of the market, limiting risk. Okay, so please don't look at the 5 minute and go, oh, okay, I'm going to day trade. A lot of people liken day trading to super active trading. That's not the intention here at all. Okay, think about it this way. And for those of you that have been joining me for our sessions these past 2 months, you know that my typical trading view is comprised of the 15-minute, the 30-minute, the 60, the 240-minute, and the daily chart. So those 5 time frames, if you were to compare to the 5-minute chart, they're practically grandmothers. They're long charts, right? A 5-minute chart compared to a 30 or a 15, that's a pretty long-term chart compared to the way a 5-minute will move. Think of each individual time frame as a slice of psychology. Because if you were to compare what a 1-hour chart is reflecting, it's a 1-hour psychology, right? You're looking at the market chunked down into all the emotion that exists in this one 60-minute candle. And in that one 60-minute candle, we could have a small rally, we could have a small sell-off, we could have all sorts of emotions that occurred during that 60-minute chunk of time, all wrapped up in that single candle. So we may not see the nuances of the fear and greed. But if you were to break that same 60-minute candle down into the 5-minute charts that helped create it, right? Think about slicing, dissecting that 60-minute chart, that 60-minute candle into the 12 5-minute candles that basically would make it up. Everyone follow me? You're dissecting 60 minutes, 1 hour, into 5-minute charts. That's 12 candles or bars or whatever you choose to use. You know, I'm a candlestick kind of gal. So 12 candles. With those 12 candles, would I be able to see rallies or sell-offs or congestion that occurred during that 60 minutes in a way that that one single candle would not be able to convey? Of course. So follow along the line. If I've got the movement, could I then possibly have the market cycles that accompany it? Sure. I might have a small markup cycle followed by a little bit of a stall or an accumulation sideways cycle, and then I might have a sell-off from there. I might have another stall and another sell-off. And with 12 candles, I could see that kind of movement. It happens much more quickly because now the slice of psychology is just a 5-minute chart. So what I'm trying to lay the groundwork for here is basically 2 things. One, I want you to understand that we're really not talking about day trading in the sense that there's an end of day. What I am trying to communicate is a shorter term time frame is actually designed to a certain degree limit the risk. Okay? So that's what I want to make sure you get, because if that doesn't kind of communicate right now, if I can't get that idea across, what happens, I find, is that when people have the ability to possibly trade with more frequency, and we're going to get more setups because we're simply going to have more candles each and every hour. Again, 12 new candles every hour. People tend to want to overtrade, and I don't want to encourage that. Just because the opportunity is there doesn't necessarily mean we should. So the 5-minute chart is a time frame that I go to when I find that longer term time frames, again my 15, 30, 60, 240 daily, are not going through the market cycles, are not moving in a range wide enough to capitalize on movement or follow through. And then I'll go to a very short term time frame because I'm mistrustful of the longer term movement. Okay? So that's what I want to kind of get across. It's about understanding that sometimes short-term psychology might be the clearest look at the trading day.